In this video, we are going to talk about interest rate swaps. So we'll start by just describing the first swap deal because I think it's indicative of how swaps work, or a way to think about interest rate swaps. So during the early 1980s, the World Bank found that interest rates in West Germany and Switzerland were lower than those in the United States. And unfortunately, they had borrowed the maximum amount they were allowed to in these two countries. So they had covenants in the World Bank's legal documents. There were covenants saying that they could only borrow so much in various countries. And so they had maxed out on West Germany and Switzerland, even though they wanted to borrow more. Now, IBM at the same time had issued loans in Deutschmarks and Swiss francs during the 1970s, but realizing that the US dollar had appreciated against these currencies and lowered the value of these loans, they wanted to be in dollars. So in 1981, Salomon Brothers, which is now part of Citigroup, organized the first swap on a notional of $290 million. And the World Bank borrowed dollars by selling Eurobonds and converted those into Deutschmarks and Swiss francs. So they borrowed dollars, and then the World Bank and IBM exchanged each other's loan obligations. So before the deal, IBM had borrowers in Deutschmarks and Swiss francs and wants to repay in dollars. So they had Deutschmark and Swiss franc investors. The World Bank wanted to borrow in Deutschmark and Swiss francs but weren't allowed to. So what happened? The World Bank borrowed in dollars, and then instead of paying dollars, what they did was they paid Deutschmarks and Swiss francs to IBM, and IBM paid them dollars. So if you see, IBM's cash flow, paying dollars, flows through the World Bank to the Eurobond investors. The World Bank's cash flows, paying Deutschmarks and Swiss francs, flow through IBM and pay their investors. IBM doesn't have to pay Deutschmarks and, well, IBM pays Deutschmark and Swiss francs, but only the ones they get from the World Bank. So effectively, IBM's not paying Deutschmark and Swiss francs. IBM's net cash flow is US dollars. The World Bank's net cash flows are Deutschmark and Swiss francs. So even though the World Bank borrowed in dollars, they effectively were able to pay, and it was like they borrowed in Deutschmarks and Swiss francs. And IBM effectively were able to turn their Deutschmark and Swiss franc liabilities into dollar ones. And of course, Salomon Brothers earned a fee for organizing this trade. Now, this is the classic way of looking at interest rate swaps. You find two companies out there who want to do opposite things, and they do the swap in between. Those are the cash flows in the middle. They do the swap, and they're able to do what they wanted to do. The reality is this isn't really how the swaps market works anymore, because the swaps market is a dealer-driven market. And so IBM would go to Salomon Brothers and say, I want to swap my Deutschmarks and Swiss franc cash flows into dollars. And the World Bank independently, and probably at some completely different time, would approach Salomon Brothers or some other bank and do the opposite. And Salomon Brothers would have two fees they would earn, one from IBM and one from the World Bank. So this is really a dealer-driven market. There's enough trading activity in this market that Salomon Brothers does not, or Citigroup now does not have to find IBM and World Bank at the same time in order to execute the trade. Okay, so a swap, what is a swap? A swap is an agreement to exchange cash flows at specified future times according to certain specified rules. So that's a pretty useless definition. Typically, swaps have two legs, as there are two parties swapping cash flows. So counterparty A pays cash flows to counterparty B. Counterparty B pays cash flows, different ones, to counterparty A. Now, there are interest rate swaps. That's what we're going to talk about. And these are often exchanging fixed cash flows. So we have some fixed rate, 5%, versus cash flows linked to a reference index. We'll talk about ones linked to LIBOR in this class. We have currency swaps, exchanging fixed payments in one currency versus fixed payments in another currency. We have equity swaps, exchanging fixed cash flows versus the return on an equity index. We have commodity swaps, fixed cash flows versus the price or the return on a commodity, and so on and so forth. There are tons and tons of different kinds of swaps. The interest rate swap market is an enormous market. Okay, so we're going to talk about vanilla interest rate swaps in this class. So a vanilla interest rate swap is an agreement to swap fixed rate cash flows for floating cash flows over a specified period of time. So there's a principal. What are the cash flows based on? If I have a principal of $100 million and 5% semi-annual cash flows, then I'm paying $2.5 million every 6 months. There's a maturity, so swaps don't last forever. Maturities tend to be started about 2 years. Currency swaps, equity swaps may be a little shorter, but interest rate swaps tend to start around 2 years, and then their maturities 2, 3, 4, 5, 6, 7, and so on, out to about 30 years. They probably trade every year out to about 10 years, then every 5 years out to 30 years, and then there's often you'll find 50-year swaps out there, depending on the currency. You have a tenor. How often are cash flows paid? Now, in the US, floating cash flows are typically every 3 months, and fixed cash flows are every 6 months. So that's just slightly annoying and slightly hard to manage. We're going to work in a world where everything's 6 months, just to make our lives easier. Now, floating cash flows reference a trusted benchmark rate, something like LIBOR, although we're in a world right now where that's changing. But we're going to talk as if LIBOR is still a reasonable benchmark rate, and if it changes, we'll worry about that when we get there. Okay, now generally the reference rate, say LIBOR, is fixed at the beginning of a period and paid at the end. Right? If we look at a screen and look up what 3-month LIBOR is, 3-month LIBOR is a rate that starts right now and goes for the next 3 months. And so the interest owed on a 3-month LIBOR would be owed at the end. And so LIBOR kind of felt these swaps work roughly the same way. Okay, so an example. Let's have agreement by Microsoft to pay 6-month LIBOR and receive a fixed rate of 5% per annum every 6 months. Again, as I said, typically they would be paying 3-month LIBOR, but let's just make our lives a little easier. Well, the start date, 5th of September 2015, maturity 5th of September 2018. So this is a 3-year swap on $100 million. Now, the next slide is going to illustrate some cash flows, and they're not totally realistic cash flows because we haven't been really precise or careful about how we calculate those cash flows. But we just want to see how this works. So, typically, when I'm drawing this interest rate swap, I will draw a line which represents time into the future. And then an arrow going up will be a cash flow that I am receiving, or in this case, Microsoft is receiving. And an arrow going down is a cash flow that Microsoft is paying. Now, on the 5th of March 2016, again, that's 6 months after the start of the swap, Microsoft is going to receive $2.5 million, 2.5% of $100 million. Remember, the fixed rate was 5%. That's an annualized rate. We're paying every 6 months, so 2.5. And they're going to pay 6-month LIBOR. Again, the 6-month LIBOR rate was a rate they looked at, they found 6 months prior to March, so 5th of September 2015. The next cash flow happens 6 months later. On the 5th of March 2016, we look up what 6-month LIBOR is. Whatever that rate is what's going to be paid on the 5th of September. They're going to receive 2.5%, the same fixed cash flow. They're going to pay whatever 6-month LIBOR was, and so on and so forth every 6 months. Again, the LIBOR fixings are 6 months prior to the cash flow being paid. Now, when the cash flow is paid, we make that payment. And again, you can see there's a cash flow Microsoft's receiving, there's a cash flow Microsoft's paying. And so the way this really works is those two cash flows net down to something. Might be a cash flow in Microsoft's favor, might be a cash flow in the counterparty's favor. But they net down to something, and one cash flow, physical cash flow, is made. In other kinds of swaps, like a currency swap, that might not happen. If we're swapping Mexican pesos for euros, most likely both cash flows actually take place. Now, here's an outcome for the cash flows perhaps. So on the 5th of September, we figure out what LIBOR is, and that determines the floating cash flow. In this case, LIBOR was 4.2%. We're just going to use day count fractions of a half. So 4.2%, $100 million notional, negative $2.1 million. That's how much Microsoft has to pay on the 5th of March. They're going to receive $2.5 million. So net, they're going to receive $400,000. On the 5th of March 2016, there's a new LIBOR fixing. After this cash flow of $400,000, we look at a screen, we find out LIBOR is 4.8%. Microsoft has to pay $2.4 million on the 5th of September. They receive 2.5, net they receive $100,000. The LIBOR is going up 5.3%, turns into $2.65 million that Microsoft has to pay. They receive 2.5, net they pay $150,000. And so on until the end of the swap. Now this is pretty typical that one party of the swap, often, though not always, the party paying the floating cash flow, will receive money at the beginning of the swap and pay money at the end of the swap. Now the reason for that is often interest rates are lower in the short term than they are in the longer term. It's not always true, but it's mostly true. So because interest rates are lower in the short term, 6-month LIBOR is lower than 3-year interest rate swap rate. So the 2.5% that Microsoft's going to receive is going to be higher than the money they have to pay. Eventually, that switches, and we end up that Microsoft is going to pay money at the end. They receive money at the beginning. All right, so what are interest rate swaps used for? They're often used for converting a liability, some kind of liability. Again, a good liability to think about here would be a bond. So we convert a liability from a fixed rate to a floating rate, or floating rate to fixed rate. We might convert investments. Again, we can think bonds. I have investments, they're fixed rate bonds. I want them to be floating rate. I have floating rate bonds. I want them to be fixed rate. So basically this is all about conversion of a rate from fixed to floating or floating to fixed, depending on which way we do the interest rate swap. So let's take a bond. Let's say Microsoft have issued a bond. Now I'm really setting this up nicely for me. So $100 million notional matures on the same day as that swap, 5th of September 2018. Semi-annual coupons, fixed payments of 5%. The day count convention here is 3360. We don't need to worry about how that works other than the cash flows are always 2.5%. So Microsoft have issued this bond and they owe $2.5 million every 6 months for 3 years. We can enter into the swap, the same swap we just did. Right? See here, Microsoft is receiving fixed and paying floating. The amount they're receiving fixed is the same as on that bond that they have to pay. So the resulting exposure is they have a floating rate bond, right? The fixed cash flows net out, Microsoft is left paying floating rates. 6-month LIBOR every 6 months until the maturity of the trade. So basically through this swap, and we've totally stylized this to work, but through this interest rate swap, Microsoft have issued a fixed rate bond, they've entered into an interest rate swap, and now they've effectively issued a floating rate bond. Now, one thing that should be said, the market for corporate bonds is mostly fixed rate bonds, right? Corporate bonds are almost all fixed rate bonds. Why? Because that's how it is. That doesn't mean that Microsoft, when they issue a new bond, wants to issue a fixed rate bond. It just means that that's what the market wants. So what does Microsoft do if they want a floating rate bond? They issue the fixed rate bond into the market, and then they enter into an interest rate swap with their investment bank. Now, Microsoft have effectively issued a floating rate bond. And this is actually going to be one of the questions that many of you may get when if you're in a corporate bond or corporate office, treasurer suite, issuing debt. You're going to probably issue fixed rate debt, and your investment banker is going to say to you, do you want to swap it into floating? And this is what they're talking about doing. Okay, swap usage. What do we use swaps for? So One, let's say I want outright exposure. I want to profit from rising interest rates. If I want to profit from rising interest rates, do I pay fixed or floating on an interest rate swap? Well, if I pay fixed and receive floating, then when interest rates go up, the amount I pay stays constant and the amount I receive gets larger. So I'd like to pay fixed and receive floating. What if I want to profit from falling interest rates? Well, then I don't want to pay fixed and receive floating, because if interest rates fall, the amount I'm going to receive are going to fall. So I'd like to pay floating and receive fixed. So I can just use an interest rate swap to profit from changes in interest rates. And in fact, once the interest rates have changed, all I have to do is unwind the interest rate swap and I lock the money in. I take bonds that already exist. This is kind of what we already saw. If I've already issued a 10-year bond and I'd like my interest cost to fall if interest rates fall, well, I'm already paying fixed on the bond. So what I'd like to do is receive fixed, pay floating, right? Receive fixed, that offsets the fixed rate on the bond, pay floating, and now if interest rates fall, I reduce my interest costs. What if I had a bond portfolio? So suppose I manage a portfolio of 10-year fixed rate bonds and I'm worried about rising interest rates. Well, I'm receiving fixed on the bonds. If interest rates go up, the bond prices go down and I've got a problem. So what do? Well, I'm receiving fixed on the bonds. I pay fixed on the interest rate swap and receive floating. Now if interest rates go up, my bond values fall, but effectively I own floating rate bonds, and floating rate bond values shouldn't fall if interest rates go up. All right, fixed rate bond values should fall if interest rates go up. Floating rate bond values should not fall if interest rates go up, which means that, yes, I lose money on the bonds because interest rates are higher, but I make it back on the interest rate swap. Bond issuance. I'm a corporate treasurer. I'm about to issue a new bond. I want to issue a floating rate bond. What does the market want to buy? Fixed rate debt. What do? Issue the bond because that's what the market wants, and enter into an interest rate swap where I receive fixed, pay floating, net I have issued a floating rate bond. What about if I'm a corporate treasurer and I want to issue a 10-year bond in 6 months? So I don't want to issue it right now. I want to issue the bond in 6 months, but I'm worried that rising interest rates are going to make this more costly, right? If interest rates are 4 right now and they might be 6, I'm worried they might be 6 in 6 months. Well, when I issue the bond, I'm going to end up paying higher interest. So what I can do is go short a bond, the 10-year note futures contract, again, matching that bond. We talked about this one before. Or I could pay fixed on a forward starting interest rate swap, starts in 6 months, goes for 10 years from the 6-month period. And that's an equivalent trade. And if I pay fixed on the forward starting interest rate swap, it's kind of like I've issued the bond already. Now, when I go and issue the bond, what do? I unwind the interest rate swap. If interest rates are higher, the present value of that interest rate swap is going to be higher. It's going to be higher by how much? The present value of all those cash flows, those additional interest cash flows. So it should net out to be, if interest rates went up by 2%, the swap that I entered should be worth that 2% cash flow over the 10 years. And so I can hedge a risk that I don't even have right now. I can hedge a risk that doesn't appear on my balance sheet. It's just that I know I want to issue a bond. I haven't done it yet, but I want to lock in the rates currently.